Good morning students, welcome back to today's class. Today we are going to see that chapter 5 of Accountancy, Accounting Ratios, video number 8. So here we are going to see that activity turnover ratio. So from this activity turnover ratio, we can find out that the relation between the asset put to turn as that revenue, or how much time that asset or part of asset is turned into revenue. So that relation, that means the asset of the firm or part of that asset which is turned into that revenue, that relation, or how much fast. That high turnover ratio is showing that better. That means that much effectively or efficiently we utilized that the asset of the firm to form of the revenue. You understand now? If revenue is required, main aim is that make that revenue. Out of that revenue only we are getting profit. That ratio we are going to see in that next one, that profitability ratio. But here first we are going to see that how much time, this we are showing in times, number of time that our asset or part of asset which is turned as to revenue. In that few ratios are there. One is that inventory turnover ratio. Inventory means you know that the stock. Next is that trade receivable turnover ratio, trade payable turnover ratio, investment turnover ratio, fixed asset turnover ratio, working capital turnover ratio. These 6 are there. We can see that one by one. First is that inventory turnover ratio. Very simple only, very simple formula also. But the problem is that you need to, for better understanding, you need to solve that more and more questions. Some questions are simple, some questions are average, and some questions are difficult too. So here formula is there for inventory turnover ratio. In order to find out that inventory turnover ratio, one simple formula is cost of revenue from operation divides average inventory. Cost of revenue is also sometime cost of goods sold. Or to find out that cost of goods sold, we are using that mainly different two formulas are there in order to find out that cost of goods sold or cost of revenue from operation. That is opening stock plus direct expenses plus purchase minus closing stock. If you don't have that formula, you can write that with a pencil or somewhere else in your textbook. Cost of goods sold is equal to opening stock plus direct expense plus opening stock plus direct expense plus purchase minus closing stock. And this is one formula. One more formula is there. Purchase minus closing stock. One more formula is there to find out the cost of goods sold. Revenue from operation minus gross profit. Revenue from operation, this is another formula for the same. Revenue from operation minus gross profit. Revenue from operation minus gross profit. Sometime instead of gross profit, gross loss may be there. Sometime instead of gross profit, gross loss may be there. In case of gross loss, you have to plus that. That means revenue from operation plus gross loss. You understand or not? Minus instead of that plus. So here inventory turnover ratio is at a how much time that inventory turn into revenue. How much time that inventory turn into revenue. So to show this relation, we are going to see that the inventory turnover ratio, its formula is that the cost of revenue from operation divides average inventory. Average inventory means, what is that? What is meant by average inventory? This is an arithmetical average. Yes, inventory in the beginning plus inventory in the end divides by 2. Then you will get that average inventory. Clear now? So we are going to say one question related to this. Here you understand this, formulas are very important, okay? If you are getting that formulas and that relation also, not only formula, this relation. Now you can see that this cost of revenue we can find from different ways, and sometimes that cost of revenue and cost of goods sold is same. So what are the relation you have to understand properly. Question is this: from the following information calculate inventory turnover ratio. Informations are here. Inventory in the beginning, that means opening stock, 18,000. Inventory at the end, that is closing stock, 22,000. Net purchase, total purchase, 46,000. Wages, 14,000. Revenue from operation, 80,000. Carriage inwards, 4,000. So we are putting that formula here. What is our formula? Inventory turnover ratio. Ratio is equal to cost of revenue from operation one average. So first we need to find out the cost of revenue from operation. Here two formulas I gave to find out the cost of revenue from operation. Cost of revenue from operation. What is the formula? Okay, inventory in the beginning plus net purchase plus direct expense plus or minus closing inventories. So according to that, we say that amount. Inventory in the beginning, how much is at the opening? 18,000 plus direct expenses. Here you can see that direct expenses, that you need to understand what are the direct expenses. That is wage is there and carriage inwards are there, no? Then that is 46. How much is the amount that day? Wage is 14. Find out that day. What are direct expenses here? Wages. How much is wages? 14,000. 46,000.
40,000 wages.
Stand up those who. So what are the direct expenses? Wages. That wages is at 14,000. Then Carriage invoice. How much is that? 4,000. Total? Then what is this amount? You don't need of going directly to the other test book. Here in formula I already give you that what is that cost of revenue from operation. In that I said that opening inventory plus direct expense. All direct expense you can put together plus net purchase minus closing stock. Then you first add that direct expenses. Your direct expenses are 200, 40,000 plus 4,000. Wages plus carriage involved. That amount is at how much is there? With this what we are again adding? What we are adding again? You don't know. Net purchase. How much is that amount? 46,000. And from this what next we need to do? Minus closing. How much is that closing? 22,000. And find out that amount. That is known as the cost of revenue from operation. How much is that? 60,000. 60,000. Now what we got? This we got. Cost of revenue from operation. Next again. Average inventory we need to find out. For average inventory, how much is that opening inventory? 18,000 plus closing inventory 22,000 divided by how much is that total? 20,000 as answer. So average inventory also we got. Now we put that is in that equation. That is 60,000 upon 20,000. How much is there? So answer is that 3 times. That means the inventory here turned to revenue as 3 times. Clear now? Just much only. Very simple one.